Have you ever looked at India's income tax law and thought it's just this impossibly complicated maze? Well, let's try thinking about it a different way. Forget the maze. Instead, picture a detailed blueprint. And in this explainer, we're going to walk through that blueprint piece by piece so you can see its foundation, its structure, and how it all really fits together. So, let's jump right in.
Everything, and I mean everything, starts right here. This one sentence from the Constitution of India is the absolute bedrock. What it means is simple. The government can't just decide to tax you. They need a law that gives them the power to do it. It's the most important rule of the game.
And that is the million-dollar question, isn't it? If everything needs the authority of law, then what exactly makes up that law? Here's a hint. It's not just one book. It's a whole interconnected system, and we are about to break it all down.
Okay, so first things first. To understand this blueprint, we have to start at the foundation. Where does the government get the fundamental power to create a tax law in the first place? Well, it's not just pulled out of thin air. It's written down in the country's most important document.
The ultimate power source is Article 246 of the Constitution. You can think of it like a master switchboard. It gives the central parliament in Delhi and all the state legislatures the authority to make laws, but only on specific subjects that are assigned to them. And those subjects are all neatly organized. So how is it organized? Through these three lists in what's called the 7th schedule. They basically create different lanes for making laws. The union list is for national issues, so only Parliament can make laws there. The state list is for the states, and the concurrent list is for stuff where both can legislate. This division is absolutely crucial.
And here it is. This is the smoking gun. Right there in the union list, at entry number 82, is the specific clause that gives Parliament the exclusive green light to make laws about income tax. This is the exact constitutional permission slip for the entire Income Tax Act.
Right, so we've laid the foundation. Now let's look at the actual structure that's built on top of it. You see, the law we're talking about isn't just one thing. It's really a system supported by 5 distinct legal pillars. If you understand these 5 pillars, you understand the whole system.
All right, here they are, the 5 pillars. You've got the main Income Tax Act itself. Then there's the Annual Finance Act. You have the income tax rules. Then these things called circulars and notifications. And finally, the decisions that come out of our courts. Each one has a totally unique job. Let's take a look at them one by one.
First up, the big one, the Income Tax Act of 1961. This is the main frame of our entire blueprint. It's the core text, the primary law, with all the sections that define what income is, how it's taxed, and all the fundamental principles. This is the heart of it all. Next, we have the Annual Finance Act. Now, if the main act is the blueprint, think of this as the annual update. You know, the thing everyone talks about during the budget. This is the tool the government uses every single year to tweak tax rates, add new rules, and basically keep the law from getting outdated. It's what makes the system dynamic.
Now we get into the really fine details. The income tax rules are like the internal wiring and plumbing of our blueprint. The act tells you what to do, but the rules tell you how to do it. Which form do you need to fill out? How do you calculate a specific value? All that nitty-gritty procedural stuff is in the rules.
Okay, these next two often get mixed up. Circulars and notifications. Think of it like this. Circulars are like internal memos from the tax department, the CBDT, to its own officers to clear up any confusion. They're basically guidebooks. Notifications, on the other hand, are formal public announcements from the central government that have the force of law. They bind everybody, taxpayers and the department included. And our 5th pillar, case laws. Look, no law can possibly predict every single situation that might come up. So when taxpayers and the tax department disagree on what a rule means, they go to court. The decisions from the high courts and the Supreme Court set a precedent, clarifying the law for everyone else. They're like the ongoing renovations and interpretations of our blueprint.
So we just said the Finance Act is that big annual update. But how does that actually happen? This process is what millions of us tune in to watch every year. It's the engine room of our tax system.
It all starts as a proposal called the Finance Bill. The finance minister introduces it in Parliament during the budget session. It gets debated, maybe changed a bit, and eventually has to be passed by both houses. After that, it goes to the president for a final signature. That's called the assent. And boom, just like that, the bill becomes the Finance Act and the tax law is officially updated for the year.
Now, the real juicy part of the Finance Act is in its first schedule. This is where you find the actual numbers that impact your wallet.
Part 1 tells you the tax slab rates for the year that just ended. Part 2 gives you the TDS rates for the year ahead. Part 3 covers things like advanced tax. It's the practical, number-crunching part of all those big budget speeches.
Okay, so we have our blueprint. We know all its different parts. But here's the thing. Just having the blueprint isn't enough. You have to know how to read it. And legal documents aren't read like regular books. There are specific rules for figuring out what the words actually mean.
The first and most straightforward approach is called the literal rule. It's simple. Read the law exactly as it's written. Give the words their plain, ordinary meaning. But what if that leads to a totally absurd result? Well, that's where the golden rule comes in. It says, sure, start with the literal meaning, but if it creates a ridiculous situation, you can tweak the interpretation to find a more sensible one.
And then there's my favorite, the mischief rule. This one's like being a detective. It asks, what was the problem, or the mischief, that Parliament was trying to fix when it wrote this law? Once you figure out the original problem, you interpret the law in a way that best solves that problem. It's all about getting to the why behind the words.
Building on those general rules, judges also have specific ways of reading different types of clauses within the Tax Act itself. You see, not every section is created equal, and how you read it really depends on what its job is.
This really gets to the core of it. A charging section, that's the part that actually imposes a tax, is read very strictly. If the language isn't crystal clear, the tax doesn't apply. But a machinery section, which is about how to collect the tax, is read more practically to make sure the system actually works. And when it comes to penalties, any doubt benefits the taxpayer.
And to do all this interpreting, judges have a whole toolbox of aids. There are internal aids, which are clues you find right inside the law itself. Things like provisos that create exceptions or explanations that clarify a tricky word. And then there are external aids, stuff outside the law, like parliamentary debates, official circulars, or even just a simple dictionary to figure out what the lawmakers really meant.
So, if you take away one thing, let it be this. India's tax law is not some static, dusty book sitting on a shelf. It's a living, breathing blueprint. It's drafted by Parliament, it gets updated every year by the Finance Act, it's filled in by the rules, clarified by the Tax Department, and constantly reinterpreted by the courts. All 5 pillars are always at work, together.
Which brings us to a final thought. When you think about all these moving parts, the acts, the rules, the interpretations, the court cases, it really makes you wonder, is tax law a precise science where there's always one single correct answer? Or is it something more like a continuous, evolving conversation between the government and its citizens? Something to think about.
All right, let's talk about something that can feel, well, super complicated. The language of the Indian Income Tax Act. It might seem like it's written in another tongue, but I promise, by the end of this, you'll get the hang of the core terms that make the whole system tick. Let's dive in.
Have you ever felt like you need a secret decoder ring just to read a tax document? I think we've all been there. You see these words, assessee, perquisite, capital receipt, and your eyes just glaze over. It feels like it's designed to be confusing. But what if we could just translate it?
Well, that's exactly what we're going to do right now. We're going to break it all down with a really simple framework. Who pays the tax, what actually gets taxed, and how it all gets calculated. Think of this as your personal translation guide.
So let's jump right in with the who. Before you can even think about taxes, you've got to figure out who the law is actually talking to. And the very first, most fundamental word we need to know is person. Now, the key word here is inclusive. Notice the law doesn't say a person is only this or that. It says a person includes certain categories. And that's not an accident, It's a clever way to make the definition as broad as humanly possible, casting this huge net for anyone or anything that might have to pay tax.
And yeah, the list of what counts as a person is probably wider than you think. Of course, it includes an individual, that's a human being, like you and me, but it also includes a Hindu undivided family, a company, a partnership firm, and even some really interesting ones like a local authority or something called an artificial juridical person, which can be anything from a university to a temple deity. The law sees each of these as its own taxable unit.
Okay, so that's a person. Then what in the world is an SSE? Think of it this way. An assessee is a person who's actually in the game for a particular tax year. They've gone from being a potential taxpayer to an active one. This could be because they owe tax, are involved in a tax case, or are even waiting on a refund. And this leads to a really important idea, a sort of mantra in tax law. Every single assessee is, by definition, a person.
But not every person is an assessee in any given year. It's a one-way street. One is the potential, the other is the reality for that specific year. So, to put it all together, person is the big, wide universe of everyone who could pay tax. An SSC is the specific somebody from that universe who actually has to deal with the tax department this year. Simple as that. Now that we know the who, let's get into the what.
All right, so we've got the who down. But what are we actually taxing? The obvious answer is income, right? But of course, with tax law, it's never that simple. The legal definition is, you guessed it, a little more specific.
And look at that, there's that word again, includes. Just like with the definition of person, the law keeps the definition of income open-ended. It's a really powerful tool for the government because it means they can add new forms of income to the list as the economy changes without having to rewrite the whole law. It keeps the tax base flexible.
So what's on the list? Well, first, you've got the stuff you'd expect, right? The money you get from your job or your business. So your profits and gains, any perks you get instead of salary, special allowances, all that good stuff.
But wait, there's more. The net is way wider than that. It also pulls in things like dividends from your stocks, profits you make from selling property, what we call capital gains, and yep, even if you win the lottery or a big bet. The law says all of that is income.
Okay, now this next bit is super important. Not all money you get is treated the same. The law makes a big deal about the difference between a revenue receipt and a capital receipt. A revenue receipt is the day-to-day money your business makes. It's recurring. But a capital receipt is a one-off from selling a major asset. So think about it like this. Selling the shoes your factory makes is revenue. Selling the factory itself, that's a capital receipt, and it gets taxed in a completely different way.
And here's another one that can trip people up. Diversion versus application of income. It really all comes down to one simple question. Did you ever actually have control of the money? If money is taken away by a legal order before it ever lands in your bank account, that's a diversion, and you're not taxed on it. But if you get the money first and then you use it to pay off a debt or an obligation, well, that's an application. You had it, so it's part of your taxable income.
All right, we've nailed down the who, that's the person in the assessee. We've figured out the what, that's income. So now for the final piece of our puzzle, the how. How does the tax department actually crunch the numbers and arrive at a final figure? That whole process is called an assessment.
Assessment is just the official name for the whole process. It's the step-by-step procedure the tax authorities use to go through an SSC's income and determine exactly what's owed. It's the formal, official, doing the math part.
And it's not a one-size-fits-all thing. It's more like a path with a few different routes. It usually kicks off with you doing a self-assessment when you file your return. Then, the department might do a quick check called a summary assessment. If they find something they want to look into, it could escalate to a full-blown scrutiny assessment. And in some cases, they can even reopen an old case with a reassessment.
So we've thrown around these four big words: person, assessee, income, and assessment. And you might be thinking, okay, they're just words, but they're not. They are the absolute bedrock of the entire system. They lock together perfectly in a very logical order.
And here's how it all clicks into place. It's a simple, logical chain of events. You start as a person, one of many potential taxpayers out there. The moment you have taxable income, you become an assessee for that year. And the official process of figuring out your tax on that income is called an assessment. See? Each step flows right into the next.
And that brings us to the big question, doesn't it? All this complex, super specific language, it's all designed to be precise, to be fair, to leave no room for argument. But does it actually work that way in the real world? Does all this precision create a fair system for everyone? Or does it end up building a wall that makes it hard for regular people to even understand their own responsibilities? Something to chew on. Thanks for tuning in.
So if you earn any money in India, you're part of this really fundamental cycle. You have a year where you earn, and then a year where you get assessed on that earning. But how does this whole rhythm of earning and paying taxes actually work? Let's break it all down.
I mean, really think about it for a second. You get your salary, you're running your business, making investments. It happens all year long. But when does the government actually come in to look at that income and tax it? Well, it's probably not as instant as you might think.
You see, the entire Indian tax system is basically built on one single golden rule. It governs pretty much every case, and it is all about timing. And here it is, plain and simple. The income you earn in one financial year gets taxed in the next financial year. It's a really straightforward but absolutely crucial concept. You earn now, and you get assessed and pay tax on it later.
Now, this whole earn now, pay later system, it really depends on two key time periods. If you can understand how these two work together, you've pretty much unlocked the whole process.
Okay, so our two key players are the previous year and the assessment year. The previous year is just the financial year, from April 1st to March 31st, when you're actually earning your income. Just think of it as your earning year. Then the assessment year is the one that comes right after. That's the window when all that income gets evaluated, you file your returns, and your tax is calculated.
Let's just walk through a quick example to make it crystal clear. Let's say your earning period, your previous year, starts on April 1st, 2025. You earn income for a full 12 months, all the way to March 31st, 2026. The very next day, bam, the clock resets. April 1st, 2026 kicks off the assessment year. That's the 12-month period where the income you just finished earning gets looked at.
Okay, so you might be wondering, what happens if my income doesn't start neatly on April 1st? What if I start a new business on, say, July 1st? Well, it's simple. Your first previous year is just a bit shorter. It just runs from your start date of July 1st to the end of the financial year on March 31st. The principle is exactly the same.
So the rule is, earn 1 year, pay the next. Sounds simple, right? Predictable. But what if waiting isn't really an option? There are some very specific, kind of high-stakes situations where that general rule gets thrown right out the window.
Just imagine someone is about to leave the country forever, or a business is shutting down tomorrow. If the tax department just waits until the next assessment year, well, that person or that company might be long gone, and the tax revenue gone with them. The risk of losing that money is just way too high.
And this is the one and only reason behind every single exception. It's all about protecting government revenue. When there's a real risk that the tax just can't be collected later, the authorities have the power to step in and demand it now.
So let's dive into the 5 specific scenarios where that earn now, pay later rule gets put on hold, and income gets taxed in the very same year it's earned.
These 5 exceptions, they all cover situations with a high flight risk. First, non-resident shipping companies. They could literally just sail away. Second, people leaving the country for good. Third, temporary organizations, like one set up for a single concert that are going to dissolve right after. Fourth, anyone who looks like they're transferring assets just to dodge taxes. And finally, businesses that are shutting their doors for good. In every single one of these cases, waiting a year is just too big a gamble.
Let's take that first case, a non-resident shipping company. The authorities can't wait a year for a ship that might never come back. So they use a clever shortcut. A flat 7.5% of the total freight charges is just treated as the company's income. This is called deemed income, and the tax on that amount has to be paid before the ship is even allowed to leave the port.
And it's the exact same logic for a person leaving India permanently. If they plan on leaving on June 10th, the tax official, the assessing officer, can assess their income right then and there. They'll calculate everything earned from April 1st right up to that departure date and make sure the tax is paid before that person gets on a plane. The similar idea applies to those temporary event organizations and people trying to move assets to avoid tax. For our last major exception, a discontinued business, the key word here is discretion. The tax officer isn't required to tax them on the spot, but they have the power to. If they think there's a risk, they can assess all the income right up to the closing date just to secure the revenue before the business vanishes.
Okay, so far we've been focused on the timing of taxing income that we know about. But what about income that someone tries to hide completely? Well, the tax system has a whole other set of powerful rules for dealing with assets that never even make it onto the books.
So yeah, what happens if you've got cash or investments or other valuables that you just don't declare? The tax system has this really powerful tool called deemed income. Basically, if you can't explain where an asset came from, the law just deems it to be your income for that year. Simple as that.
And this can show up in a bunch of ways. If a huge sum of money just appears in your bank account out of nowhere, that's a cash credit. If you own investments you never wrote down, or you're spending money from some source you can't identify, a tax official can treat the value of all of that as your income and tax you on it.
Here's a super simple example. Let's say you own some gold that's worth 30,000 rupees, but your books only show that you spent 20,000 to buy it. If you can't explain where that extra 10,000 in value came from, the tax officer can deem that 10,000 to be your income for the year. It's a really direct way to get at those assets that aren't fully disclosed.
When you step back, the whole tax system is really a balancing act.
It's designed to be predictable with its earn now, pay later rule. But it's also built for swift enforcement with these powerful exceptions to protect revenue when it's at risk. Which kind of leaves us with a final thought. When is it more important for a system to be predictable and fair? And when does the need to manage risk give it the right to break its own rules?
Welcome to The Explainer. You know how income tax rules can feel super dense and, well, official? Today, we're going to break all of that down into a simple, visual guide.
Ever looked at your tax statement and just wondered what is really going on behind all those numbers? Well, that's exactly what we're doing today. We're going to piece together the puzzle of the Indian income tax system so you can see the whole picture.
All right, so here's our game plan. We're going to start with the absolute foundation of income tax, then build up to the different layers, the choices you have to make, and even a really clever rule for high earners. Let's get into it.
Okay, let's kick things off with the one rule that honestly underpins the entire system. It's the big one.
So this is basically the heart of the whole system, Section 4, and what it means is simple. You're always paying tax on the money you earned last year, not the money you're earning right now. The tax system is always looking in the rearview mirror, so to speak.
So once you know your income, how does the government actually figure out your final tax bill? Well, it's not just a single calculation. It's actually a 3-layer process.
Yeah, think about it like you're at a restaurant. First, you have the price of your main meal, right? That's your base income tax. But then you'll see a couple of extra line items tacked on at the end. And that first extra charge is called a surcharge. Now, this one is just for high earners. It's basically a tax on top of your tax. The more you make, the higher this percentage gets. We'll dig into the exact numbers in just a bit.
And then the final layer, the one that applies to absolutely everyone, is the health and education cess. It's a flat 4% charge that gets calculated on your base tax and any surcharge you might owe. This is the last thing added to your bill. Okay, this brings us to probably the biggest decision you have to make as a taxpayer. You're at a fork in the road, and you've got to choose between two completely different tax systems. So here's the deal. The government has made the new regime the default option for everyone. But, and this is a big but, you can actively choose to opt out and stick with what we now call the old or optional regime. And they each have their own rule book, especially when it comes to tax rates and deductions. So what's the real difference here? Well, it all comes down to a simple trade-off. The default regime gives you lower tax rates. It's simpler, but you have to give up most of your deductions. Think HRA, LTA, that sort of thing. On the other hand, the optional regime has higher base tax rates, but it lets you use a whole bunch of deductions to lower your taxable income. So, if you've got a lot of expenses you can claim, the optional regime might actually save you more money in the end.
Let's look at the numbers. These are the slabs for the default regime. And what you'll notice is that the steps are pretty gradual. You go from 5% to 10% to 15%. It's a much smoother climb up to that top 30% bracket. Now, compare that to the optional regime. See that? The tax-free amount is lower, and then, boom, you jump from a 5% bracket straight to a 20% bracket right after 5 lakhs. That is a huge leap. And that's exactly why deductions are so important in this system. You really need them to soften that jump.
And here's another key difference, especially for older taxpayers. The optional system has special, higher exemption limits for senior and very senior citizens. This is a benefit you just don't get in the new default regime.
Okay, and this is a really fascinating little detail that comes from a Supreme Court observation. For tax purposes, if your 60th or 80th birthday is on April 1st, the government considers you to have turned that age on March 31st. Why does that matter? It means you get to claim that senior citizen tax benefit for the entire financial year that ends the day before your actual birthday. It's a pretty neat little quirk in the rules. All right, so we've talked about the two main paths, but no matter which one you're on, some types of income are just different. They play by their own set of rules and get taxed at special, flat rates, totally separate from everything else. Yeah, we're talking about things like winnings from lotteries or online games, certain profits from the stock market, or long-term capital gains. All of this income gets pulled out of your main calculation and is taxed at its own fixed percentage, completely independent of your income slab. And then there's this category. The tax code is, let's say, very strict about this one. If you have money, investments, or expenses that you just can't explain the source of, well, that gets taxed at the highest possible rate, and you're not allowed to claim any deductions against it, period. How high is that rate?
Well, when you factor in the base tax, the surcharge, and the cess, the total tax on that unexplained income comes to a whopping 78%. That's not a typo, 78. It's a pretty clear signal from the tax department.
Okay, let's circle back to that surcharge we mentioned earlier, that tax on tax for high earners. There's a clever little safety net built into the system to make it fair, and we're going to look at that now. So imagine this scenario. What happens if earning just 1,000 rupees more actually pushes your total tax bill up by, say, 10,000 rupees? Sounds crazy, right? But it can happen when your income just barely crosses a surcharge threshold. Thankfully, the system has a fix for this exact problem.
And that fix is called marginal relief. You can think of it as a safety valve. Its entire purpose is to make sure that the extra tax you have to pay because of a surcharge is never more than the extra income you actually earned to trigger it. It keeps things from getting totally unfair right at those boundary lines.
So how does it actually work? Well, the system basically does two calculations. First, it calculates your tax the normal way, with the full surcharge included. Let's call that option A. Then it does a second special calculation. It takes the tax on exactly 50 lakhs and then just adds the extra income you earned above 50 lakhs to that. That's option B. In the end, you just pay whichever amount is lower. It's a smart way to make sure you're not penalized for getting a small raise.
So there you have it. We've walked through the foundational rule, the 3 layers of tax, the 2 big regimes you can choose between, and even the special cases. The big question left for you is, now that you understand all the moving parts, which of these tax regimes really fits your financial story best? That's the choice you've got to make.
Let's talk about India's business income tax. Now, I know what you're thinking. Tax maze. Sounds complicated, right? Well, it can be, but don't worry. Think of this as your guided tour. We're going to break it all down piece by piece.
So let's start with a puzzle. Imagine you have 4 different businesses, all right here in India. A partnership, a co-op, a domestic company, and a foreign one. And here's the kicker. They all make the exact same profit. So how on earth do they end up with 4 totally different tax bills? That's the core question we're going to unpack today.
And here's the roadmap for our tour. We'll set the stage with the basics, then we'll look at the specific rules for firms and LLPs, then cooperative societies, and after that, both domestic and foreign companies. And at the very end, we'll pull it all together so you can see how they stack up side by side.
Oh, and a quick heads up before we really dive in. Today, we're zeroing in on the main income tax rates. You know, the tax on business profits. Of course, there are other special rates, like for capital gains, but those are a whole other can of worms for another day. Today is all about the core tax rates.
Okay, let's get our bearings. Time to set the stage for our journey into India's business tax codes.
First stop, partnership firms in what are known as limited liability partnerships, or LLPs. You can think of an LLP as a kind of hybrid, really. It gives you the flexibility of a partnership, but with the legal protection of a company. Let's treat these two as our baseline, our starting point for this whole discussion.
And for these firms and LLPs, the rule is refreshingly simple. It is a flat 30% tax on their total income. That's it. No different brackets, no complicated rules about turnover, just a straightforward 30%. Nice and clean.
But hold on, it's not always that simple. For the really high earners, the government adds something extra called a surcharge. And here's the key thing to understand about it. It's not another tax on your income, it's actually a tax on your tax. And it only kicks in once your income crosses a pretty high bar.
For our firms and LLPs, that magic number is 1 crore rupees. The moment your total income crosses that line, you've got to pay an extra 12%, not on the income, but on top of your final tax bill.
So, you're probably wondering what happens if you make just, say, 1 rupee over a crore. Does this massive surcharge suddenly make you poorer? Well, no. That's where this clever little thing called marginal relief comes in. It's basically a safety net. It makes sure that the extra tax you pay from the surcharge is never more than the actual income you earned above that 1 crore threshold. So if your income only went up by 10,000 rupees, your surcharge can't be more than 10,000. It just keeps things fair.
All right, now that we've got the basics down with firms and LLPs, let's move on. Next up, cooperative societies. And this is where we start to see a few more layers of complexity pop up. You see, unlike that flat 30% rate we just saw, co-ops are taxed using slabs. It's a lot like how personal income tax works, right?
So for them, it's 10% on the first 10,000 rupees of income, then it jumps to 20% for the next 10,000, and then it's 30% on everything after that.
But, and this is a big but, co-ops get a choice. This is where strategy comes into play. They can either stick with that standard slab system and keep all their tax deductions, or they can opt for what's called a concessional regime. This gives them a much lower flat tax rate, either 22% or sometimes even 15%. But the catch is they have to give up most of their deductions. It's a classic trade-off, really, a lower rate versus keeping your write-offs. And check out how that choice completely changes the surcharge rules. If they stick with the standard slabs, the surcharge is 7% for income between 1 and 10 crores, and then it jumps to 12% for anything above 10 crores. But if they pick that concessional option, it's just a flat 10% surcharge, period. So one strategic decision can have a pretty big impact on the final bill.
Okay, let's shift gears and turn our attention to domestic companies. Through this group, the government throws another variable into the mix, and that is the company's annual turnover.
For domestic companies, it really all comes down to their size, measured by turnover. If your turnover is 400 crore rupees or less in a year, your tax rate is 25%. If you go above that, the rate bumps up to 30%. It's pretty simple. The bigger your business, the higher your base tax rate.
Now, does this sound familiar? Just like the co-ops, domestic companies face that exact same strategic choice. They can stick with the standard tax rate that's based on their turnover and keep claiming all their deductions, or they can opt for one of those concessional flat rates, 22% or 15%, but in exchange, they have to say goodbye to most of their deductions. It's the same fundamental trade-off.
And take a look at the surcharge structure here. It is a perfect mirror image of what we just saw with the cooperative societies. The standard regime has those 7% and 12% tiers, while the concessional one is a simple, flat 10%. You can really start to see a clear pattern in the policymaking here, right?
All right, our final stop on this tour takes us to foreign companies operating in India. And you'll want to pay close attention here because they are playing by a completely different set of rules. For the most part, foreign companies face a flat 35% tax on their business income in India. Now that is a pretty significant jump from that 30% top rate we saw for even the largest domestic companies. There are a few exceptions, but for almost everyone, 35% is the number.
But here comes the twist. The surcharge. Even though foreign companies start with a higher base tax rate, they get a huge break on the surcharge. It's just 2% for incomes between 1 and 10 crores, and only 5% for anything above that. Now, compare that to the 12% others pay, it's a massive difference. And this is widely seen as a deliberate policy choice to make India a more attractive place for foreign investment.
Okay, we've walked through all the different twists and turns of the tax maze. Now it's time to zoom out, pull all of these pieces together, and take a look at the big picture.
And this is where it all clicks into place. If we just look at the surcharge for the highest earning businesses, we're talking over 10 crore rupees in income. The difference is just stark. A firm, an LLP, a co-op, or a domestic company, they're all facing a hefty 12% surcharge. But a foreign company, they pay just 5%. This one table really says it all about one of the biggest differences in the entire tax code. So, after all that, what are the most important things to remember? Well, first, that there's no one-size-fits-all tax rate. The type of business you are is absolutely key. Second, that surcharge is a really big deal for high earners, and the rates are all over the place. Third, these concessional regimes have turned tax from a simple compliance task into a major strategic choice. Do you want a lower rate, or do you want your deductions? And finally, remember that marginal relief is that crucial safety net that stops the system from being unfair. And all of this leaves us with one final, big question to think about. As India's tax laws keep evolving, offering more choices and special regimes, is the fundamental challenge for businesses changing? Is it less about simply following the rules and more about making complex, strategic decisions on which set of rules you want to play by?
Today, we are going to tackle Indian tax law. We'll look at two very different sides of it. First, a tax rebate that could seriously help you out. And second, some huge Supreme Court rulings that define how big businesses have to play the game. So let's dive right in.
First up, let's talk about a number that probably matters to you. 60,000 rupees. What is it? Well, it's the max tax rebate you might be able to get. It's a straight-up discount on your tax bill. We'll break down exactly how in just a moment.
Okay, now for a number from a totally different world. 5.8 crores. This was a security deposit that a company, Male On-End Filter Systems, decided to just give up. They tried to write it off as a business expense, but you know what? The court said, no way. And why they said no is the big money question we're going to answer today.
So here's how we're going to do it. We'll start with your personal tax rebate. Then we'll get into that huge business question. We'll look at the test the Supreme Court uses, learn from 5 really important cases, and then I'll wrap it all up with what it actually means for you.
All right, first things first, let's talk about your money. We're zooming in on one specific part of the tax code. It's called the Section 87A rebate.
So what even is a rebate? Think of it like a coupon for your taxes. It's not a deduction from your income, it's a direct cut from the final tax amount you owe. But, of course, there's a catch. You've got to be a resident of India, and your income has to be under a certain limit.
And here's where you need to pay attention, because the rebate you get totally depends on which tax regime you're in. If you're in the default regime and your income is under 12 lakh, you could get a rebate up to 60,000 rupees. Pretty nice, right? But if you chose the optional regime, that income limit plummets to 5 lakh, and the max rebate is only 12,500. And the golden rule is you always get the lesser of the two, either the rebate amount or your total tax bill.
All right, let's switch gears completely. We're going from personal tax to the high-stakes chess game of corporate tax. We just saw how you can get a break. Now, let's see how the government scrutinizes every rupee a big company spends. Because when you're a business, not all expenses are created equal.
Really, it all boils down to this one simple question. The money a company spent, was it just for the day-to-day grind of keeping the lights on, or was it a big investment meant to pay off for years and years? The answer to that question changes everything. Let's make this super simple. Think of a business as a car. The gas you put in it, the oil changes, those are your revenue expenses. They're what you need to keep the car running every single day. But what if you buy a whole new engine? That's a capital expense. It's a massive upgrade that's going to boost performance for a long, long time.
Of course, in the real world of business, it's not always as clear as fuel versus engine. When the line gets fuzzy and there are millions of rupees on the table, these arguments almost always end up in front of a judge.
And that's exactly where we have to look for answers. The Supreme Court of India has tackled this question again and again, and over time, they've built a kind of rulebook for telling the difference between a revenue and a capital expense.
Here's a quick peek at 5 of those major cases. You can see right away it's a mixed bag. 2 of these were ruled revenue, and the other 3 were called capital. So, let's get into the why behind these decisions.
So, first, the revenue wins. For the Bank of Rajasthan, the court basically said that paying interest on securities was just part of their everyday business. You know, like the fuel for their car. Then you have Added Technologies. They sank money into a software project that they had to scrap. The court decided that since the project never finished and gave them no enduring benefit, it wasn't a long-term asset. It was just a business loss, the cost of trying something that didn't work out.
Now for the capital side. Remember that 5.8 crore security deposit from the beginning? The court said, look, a security deposit is fundamentally a capital item. The fact that the company chose to give it up to end a dispute doesn't magically change what it is. And in a Honda Seal case, the company paid technical fees not for daily stuff, but to build an entirely new manufacturing business. That's not fuel. That's building a whole new profit-making machine.
This quote from the Saurashtra cement case is brilliant. The company was paid damages because their new factory was late. The court said this money wasn't for lost profits. It was for the sterilization of the profit-earning source. What a phrase. In plain English, the payment was for a delay to the asset itself, the factory, not the money the factory would make, and that makes it a capital receipt.
So, after all that legal stuff, what's the takeaway? How can you or I apply this thinking to any business out there?
It really comes down to a simple 4-step test. First, just ask, is this expense for daily work, or is it a one-off setup cost? Second, does it give the business a new, long-lasting advantage? Third, and this is the tricky one, does it affect the profit-making structure, the engine, or just the profit-making process, the daily drive? And finally, what is this payment really? Like that security deposit, what is its fundamental nature?
So, at the end of the day, it all boils down to this. If you're an individual, you've got to know your income limits and which tax rebate you can claim. And if you're a business, you have to look past the price tag and truly understand the nature of your spending. That little difference between revenue and capital, it's not just some accounting term, it's everything.
And that leaves us with one last thing to think about.
These rules were created in an age of factories, steel, and machines. But as today's biggest companies build their empires on lines of code and digital ideas, you have to wonder, how are these old principles going to hold up in the next century?